When we looked at DraftKings stock on this channel before, it was so wildly overvalued, we couldn't even possibly think about buying the stock. But now the stock is down over 61% over the last year, and we're trading at just 3 times sales over at DraftKings. Does that mean this stock is a buy? We'll talk about that and more on today's show. What is going on, investors? Hopefully you guys are doing well out there. Time to talk about DraftKings, which saw its Q2 revenues come out before the bell. We had them come in at $466 million. That was growth of over 56% year over year, and it beat expectations by over $28 million. The other thing that DraftKings did is they raised their full year guidance from $2.08 billion up to $2.18 billion. Previous range was from 205 to 2.17. So they raised it a little bit, both on the low and the high end. Wall Street expectations for the full year was $2.09 billion. So if they come in towards the high end of that $2.18 billion, for the full year 2022 revenue over at DraftKings, they've certainly exceeded expectations that Wall Street had for this company. Now, the other thing that they're starting to do over at DraftKings is start to look attractive from a valuation perspective. At $2 billion worth of sales and a $6.8 billion valuation, I tell you what, you're paying just a shade over 3 times sales for DraftKings. Now, in the past, it's certainly been a lot higher. It's been 20, 30, nearly 40 times sales over that company, and that was just ridiculous, even factoring in this massive growth rate that this company is projected to have over the next couple of quarters. Wall Street expecting this company over the next 3 quarters to grow at least 50% year over year on that revenue side. Certainly some of that has to do with the popularity of the NFL season starting in just a month. Then looking out after that, Wall Street has this growing at a 20 to 30% clip or more for the foreseeable future. You are going to double your revenues very, very quickly. And I'll show you from a graphical perspective, what's that going to do from a price to sales. Right now, you're trading at just a shade over 3 times sales. If the company achieves year over year growth of 34% next year, you'll pay 2.4 times sales. Looking out into 2024, if the company grows at 28%, you're paying just 1.89 times sales. Now, complicating the situation a little bit, I think if DraftKings was your typical tech stock, that would make this stock an absolutely screaming buy. When you're doubling your revenues this quickly, paying a very small multiple for them, it tends to be a very wise thing to do in the stock market. Now, DraftKings, though, differs from some of the tech stocks we looked at because their cost of revenue is actually very high. Notice your revenue came in at that $466 million. Again, that was well over 56% growth year over year when you were sitting at just $297 last year, but the cost of revenue is really high over this company. So they had $466 million worth of revenue, but over $312 million worth of cost. That leaves very, very little money left over to generate operating profits over at DraftKings. And unfortunately, they don't do that. Look at your sales and marketing budget coming in at $197 million. While it's not up as much as I'd actually think year over year, you're at 170. You went up to this 197. If you take 197 and add it to 312, you're getting to a number well over $500 million. So just your sales and marketing and cost of revenue exceed that revenue number. Now, obviously, this company is going to be doubling, tripling, maybe even quadrupling its revenue over the next 3 or 4 years. So there's certainly an investor base believing that these numbers are going to scale up a little bit. But unfortunately, you still have product and technology cost over here going from 62 million up to 77 million. And they're still bleeding money out of the G&A line going from 198. Now, they did show some restraint that went down to 187 million in the most recent quarter. So you get this loss from operations off of $466 million worth of revenue. You still lost over $308 million. Now it is improving because, again, our revenues were more than 50% lower, and we actually lost more from an operating perspective last year. But when you stretch this out to a 6-month view, it doesn't paint that much of a better story. Last year through 6 months, In terms of losses from operations, DraftKings lost $646 million. This year, they're losing $824 million. So you have to ask yourself as an investor, yes, these revenues are going to grow, but at what point do you reach a tipping point when it comes to earnings? And quite frankly, Wall Street is not expecting positive earnings over at DraftKings until the end of 2026, when the company is expected to have about $5.4 billion worth of revenue and about 23 cents of earnings per share. That seems like a long ways away, and a lot of things can happen between now and then. Now, from a cash flow perspective over at DraftKings, actually paints a pretty bad story, especially when we come over and look at this company's cash position. We'll get to that in a moment, but I do want to show you for 6 months, we pulled down that net income number of $684 million, lost almost the same last year, about $651. Now, they have massive stock-based compensation in the most recent quarter, or over the last 2 quarters. In fact, at $322 million. When the stock was 66% higher last year, they had $323 million. So they have to accelerate the number of shares that they are giving out to employees and awarding in terms of those stock options. As the stock price goes down and the stock-based compensation number remains the same or gets elevated, well, you're going to give out more and more shares. In the cash flow statement, you do get to add this back in, but when you come down here to net cash flows in terms of operating activities, for 6 months, you burned through over $529 million. That's a massive acceleration over the previous year, where you just burned through $176. So you burned through another $147 on your investing activities and another $12 million on your financing activities. All things being considered, net cash decrease over the last 6 months is basically $100 million per month at $689 million worth of cash flowing out of this company. Now, obviously, when you come over here to the look at the balance sheet over at DraftKings, they can't burn through $600 million in 6 months and do that for very long, because this company has just $1.9 billion worth of cash. In fact, that's down from the beginning of the year when you had over $2.5 billion. So you guessed it, this company is going to have to continue to issue convertible notes, maybe take on some traditional bank debt, or just plain old equity offerings where they offer these shares up at a price and raise money that way. All of those things end up being dilutive to you, the common shareholder. So you have to factor in that, as yes, these revenues expected to accelerate very quickly, and your price to sales multiple is certainly looking forward looks really attractive based on these growth rate. The company has extremely low gross margins and is going to have to do dilutive fundraising, if not bank debt fundraising, very soon. I would assume by the end of the year, DraftKings will do another fundraising round. Now, the stock is looking exactly like so many stocks that we've looked at in the stock market. They had this massive euphoria run and has given it all back and more, but we are trading towards the top end of a consolidation range that we've identified between about $12 and where the stock is sitting right now at about $18, $19 per share. Now, if you do like DraftKings, I wouldn't rush into this one. There should be some overhead resistance right where the stock is, right about $18, $19 per share. If it bursts through that, you should have some pretty hard resistance up here at $23 per share. The press should be pretty good around this company heading into NFL football season, but I can imagine they'll do some kind of fundraising round over at DraftKings. I would expect pullbacks. Now, we have started some kind of this looks like to me kind of a bottoming formation. Whether or not it turns out to be that way, you've got higher lows. I would expect this stock to at least back test back to this upper trend line, or at least get in the range of it. That means I think you can come back and get this one maybe $15, $16 per share after the shorter term momentum kind of plays out in this stock. But this would be nothing but a speculative bet. So in many cases, we're talking about very small amount of shares in this type of company. I personally think you can actually wait until this one actually achieves this revenue growth, achieves profitability, and this stock is still not going to be wildly expensive, because these financials don't check a lot of boxes that Wall Street absolutely loves. The number one, having high gross margins. This is a low gross margin business. And then when the revenue growth starts to shrivel out of this company, well, I think the multiple is probably going to remain low on DraftKings and not expand, which I think some investors are thinking it might. Hopefully you guys enjoyed today's video. We'll be back again soon with more. Good luck with your investments.